Did we just witness a stock market breath thrust? Today wasn't just a win, it was a full-on victory lap, with every single sector flashing green on St. Patrick's Day. Happy St. Patrick's Day to all my Irish followers. But digging deeper, we saw the broad market absolutely dominate, posting a 4-to-1 outperformance against the mega caps. Now, this isn't just a random pop of optimism, it's the kind of rare data-driven signal you tend to see at market bottoms. But let's pump the brakes for a second. Is this really the bottom we've been waiting for, or are we just riding a temporary high, catching our breath after a few days without a chaotic tweet storm from the president? And that is the million-dollar question we will answer today. Do we go lower, or is this some form of a dead cat bounce? Stick around as we unpack the charts, crunch the numbers, and figure out what's the noise and what's the real signal for where this wild market ride will take us. So we've got a lot to talk about. Let's roll the tape. Welcome everybody to the Daily Recap Show, where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button, and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500, and US stocks continue their rally on Monday, with Wall Street welcoming a rise in retail sales and breathing easier due to a lack of political or tariff news. And today was really a strong day for breadth. We saw green in almost every single sector, except for the big players in each sector, including the Magnificent Seven. Now, we saw some very interesting developments. For example, look at semiconductors, right? Nvidia and AVGO were in the red today. However, the broader semiconductor complex was actually in the green. Stuff like AMD, Qualcomm, Texas Instruments. Software was in the green as well. So what we saw was the leaders of each sector take a breather, and then the smaller constituents in each sector gained. We saw the same in infrastructure. Microsoft only gained 0.2%, but the broader Microsoft sector outperforming. Apple was up 0.36%, and again, very similar situation here in the discretionary space. Amazon, Tesla, very red. The broader retail space, pretty green. Again, communications, Meta, Google, kind of red to flat today. Telecom services, stuff like Netflix, Disney, very, very green today. And then we also saw just broad market rally on the back of, well, I guess just no news and just the retail sales data we got. It was very, very green today. And this type of move off the lows, this is what we refer to as a breath thrust. When you see stuff like healthcare, financials, real estate, utilities, consumer defensives, all green, broadly green in the S&P 500, that is a telltale sign that we could potentially seeing a low put in with a breath thrust coming off the lows. Every single sector gained today. S&P 500 up 0.75%. We did see a little bit of selling here to close the bell. However, we came off these lows and really just rallied a strong move, led by stuff like real estate, energy, staples, industrials, healthcare, right? And the tech-heavy sectors, technology, communication services, the XLY at the bottom of the heap, but still positive. And we actually saw market momentum moving in the side of small caps and mid caps. They outperformed today relative to their large cap counterparts. However, large cap growth and large cap core still performed very, very well. It's not to say they weren't in the mix today. It's just we saw some outperformance in some of these smaller names, relatively speaking. And we actually saw that globally as well. Europe gained, Asia gained, South America gained, North America gained. It was a solid day for risk assets and equities as a whole. And it really just stemmed off two things. The first being the retail sales data. The numbers were weaker than expected, but they weren't as bad as some people feared. Retail sales came in at 0.2. The consensus was expecting 0.6. However, if we actually look at the retail sales control group, which adjusts for GDP, that number came in at 1% versus 0.2%. The control group is what we look at on this channel. It's probably the better arbiter of total retail sales and aggregate retail sales. So that came in significantly better than expected, saying, so the underlying economic weakness, while it's there in the headline figures, if you dive a little bit deeper under the hood, we are seeing some positive developments. And then if you actually just take retail sales and exclude autos, right, 0.3 versus 5.4. So a lot of the weakness we actually saw was actually masked by auto sales here in the headline figure. So retail sales not as weak as some people were expected. And the second thing that helped move markets today was it was just another slow and boring day. There was no new tariff news, no new headline news. And as a result, stocks gained. And there were some definite market movers. Intel was up 6.8% after Reuters reported that the chipmaker's new CEO, Lip Bhutan, is considering significant changes to the company's manufacturing and artificial intelligence strategies. The street loves to hear the stuff. What Intel is currently doing hasn't been working. The stock's down 70% from its highs. And to see massive changes are being made, the street loves to see that. It means the company's going in a different trajectory. Now, this obviously was an anonymous source with ties to the company. However, what we can see, and the rumors are that the new CEO is looking to restructure Intel's approach to AI and put it back in the leadership position. Tesla fell significantly today. It was down 5% as the EV maker offers a free self-driving trial in China. Now, the reason why that's terrible is because Tesla owns all their dealerships, right? And because of that, they have like hour-to-hour data of their total sales, and they know exactly the amount of sales they're doing, right? And as a result, they can dynamically adjust their price. It's one of Tesla's moats, right? They can dynamically adjust their price to meet demand and supply. And when you see this type of discounting or this type of incentives where you're offering free self-driving in China, it means that sales are not as strong for that day or for that week. And you're trying to incentivize people to go in and get a Tesla. And that's exactly what they're doing. So the street know this. This is well known. That is why Tesla was down 5% today, now $237. Nvidia was down 1.76% ahead of its annual GTC conference. That is tomorrow, where Jensen Huang is expected to debut the company's upcoming AI chip Blackwell Ultra and its new AI super chip Vera Rubin. The stock was up in the pre-market, falling, I think just on the back of the fact that we saw, again, that deep rotation under the hood, and you're going to sell one of your biggest winners of the last 2 years, that is Nvidia, rotate into the broader market. And breadth was great today. We saw 4,600 advances, 1,700 decliners, net positive inflows from the NASDAQ and the New York Stock Exchange. And then market momentum continues to improve on a day-to-day basis. We saw more improvement here in the 5-day moving average, and we're just waiting for some of these shorter-term moving averages to turn favor. That's above the 50% mark and extend into the longer-term moving averages. But we can see very positive developments. Look here, 26.11 on Friday, 36% of stocks above their 20-day on today. And the same trend is true with the 50, 100, and 200-day moving average. This is the type of stuff you love to see. You want to see that improvement. And once we hit that 50% mark, stocks can continue to rally as they were. But let's hop on the charts. Now, risk assets and equities were broadly green today, seeing a little bit of sell side here in the after hours, but inconsequential really. The S&P 500 and NASDAQ 100 are up about 0.5 percentage point each. The IWM, the RSP, mid caps and small caps were all up in excess of 1%. So again, that rotation under the hood happening, that breadth thrust into the broader market is a real positive sign that we could be putting in a bottom here in the S&P 500 after this 10% correction. And not just in the S&P 500, but in the broader stock market as a whole. Do continue to expect near-term volatility. We can see the spot VIX is still slightly higher than the front-month VIX. This tells us we should experience near-term volatility, but this near-term volatility does have an expiration date, especially as these contracts expire and roll over into the next month. That happens this week. Looking at yields, we had mixed price action. The 2-year yield rose, the 10-year and 30-year yield fell. The dollar fell as a result as well. AGG, TLT, and bonds gained. Bitcoin was up 1.7%, still at this 83,000 level, consolidating. Gold gained 0.5 percentage point today. Silver was flat. WTI gained 0.5 percentage point as well. And it looks like the S&P 500 has actually put in a bottom. We just had the second green day in a row. However, definitely not as strong of a green day as you would expect. Now, we are in positive gamma. That means our target is the 57.77 area. However, in this massive downtrend, look at this wick here on this chart, right? So when you see a stock or when you see a candle with that type of wick, It means we opened right here. The bulls took us all the way to the top, but they couldn't sustain that momentum. They couldn't close that momentum at the top of the day. So we saw a big wick here, which means sellers came in, shorts put on their shorts, bulls closed off a lot of their position, and we closed at about the halfway mark of the day. So at one point we were up significantly higher, up more than 1% in the S&P 500. However, the bears seeing value and putting on their shorts. So that is a little bit of a concern for bulls, that wick right there. However, we are in positive gamma, and today was a very solid day, coming off Friday's solid day after that gap up and go. Now, it really depends what we're going to do tomorrow. I think what we're going to see is a retest of this gamma flip early tomorrow ahead of the FOMC, okay? And then that's going to determine where we go next. If we hold this gamma flip zone, we probably will go higher. However, if we break below the gamma flip zone, we will definitely go lower. So tomorrow's trade is going to be the defining moment because we kind of know what the FOMC is going to do. I don't think they're going to cut rates. They're going to stay on hold, but the economic projections is what can shift the market. But if anything, we're going to get economic projections that are going to be more favorable towards rate cuts. In my personal opinion, that's what I feel like. We're probably going to get a little bit more dot on the dovish side just to give the Fed a little bit of dry powder. However, I think the bears kind of realizing that and taking advantage of that with that wick right there. I think we saw a very similar situation with the NASDAQ 100. Just a big wick after a pretty solid day. It was still a green day nonetheless, but where we really saw some solid buying was in stuff like the RSP, the IWM, small caps, and look at the RTY. The wick, there was a wick at the top, but it wasn't as pronounced as something like the S&P 500, and you love to see that. Also up 1% on the day. Very, very solid day. All of these indices are back in positive gamma, which means we target the upper end of the core resistance. For the Russell 2000, that's just under the 2100 area. The S&P 500, that's 57.77, and the NASDAQ 100, that's 2320, so 20,300. So far, this tactical bounce is panning out very, very well. For this to be anything more than a tactical bounce, I want to see us retake this level right here. But in the here and now, we probably have to hold this gamma flip zone. Listen, the bears are still well in control. The bears are definitely emboldened. We are still in a daily downtrend. Don't get me wrong, I would even say a weekly downtrend. And until we actually go ahead and close this week on a positive week, that's when I can say, hey, we can maybe start targeting upper levels. But until then, we want to remain cautious. And as long as we stay above the gamma flip this week, that is positive for the bulls. However, it's all going to be dependent on the FOMC, right? That is the big news this week that's really going to move the market, and specifically the economic projections. But we are in negative, but we are in positive gamma, so you want to target the upper ends of the range. Now, looking at gold, we're officially trading above the 3,000 mark right there. And I've seen some price targets for gold hit 4,000. Goldman Sachs came out and said they're doing a 3,500 gold target. I do think gold is probably going to go higher, but I still want to see decent pullback just to reset expectations here for gold. And I would love it if we can get to the 2,700 area, but I'm not sure if we're going to get that, because to pull back to this 2,700 area, that is actually a 10% drawdown peak to trough. Nothing crazy. 7% at the upper end, 8% at the lower end. Interesting. So yeah, once we get to this level right here, an 8% drawdown, we can pull back to this level. That would be very, very welcome. And I would actually load up quite a bit of gold in this area right here. Bitcoin continues to consolidate at this mid $80,000 area. Now, if you actually go ahead and look at the M2 money supply indicator, offset by 72 days, I've been thinking maybe we should offset this to 100 days. I'm going to be doing a bit of back tests. Okay, we're still loading, but you can see that global, you can see the Bitcoin follows M2 money supply and global liquidity very, very closely. We're looking for a bottom to form around about in the next 7 to 10 days for Bitcoin, right? That actually will coincide with the March OPEX, which is on the 3rd of the 21st. And then we're looking for a move up for Bitcoin. But what you can definitely say is that we are sort of forming a bottoming process right here. And you can see that Bitcoin follows the global M2 money supply very, very closely. And it's a trend that's been going on quite a while. M2 money supply global liquidity has increased as of late, and we would expect this to trickle down into Bitcoin. And that offset is normally about 2 to 3 months, about 72 days in our case. Guys, looking at single stocks that I think are great buys right now, a stock I've been looking at quite a bit is Evolution AB. I continue to buy this name, and I think once we break this $80 area, it is onward and upward, up 0.84% today. So outperformed the S&P 500 and the NASDAQ 100. And this is somewhat of a large cap stock, especially considering the geography it's in. I've been buying a lot of PayPal as well. I think there's definitely value right here. You can see we're consolidating at the $70 area, $80 area. I think you want to accumulate PayPal right here because we will go ahead and retake this $94 area. We're just seeing a little bit of a reset of expectations. A great place to add if you missed the rally that we had all last year. And a stock I've been looking at very, very closely, a stock I haven't bought just yet, is Novo Nordisk. This stock's been a bit of a dumpster fire in the last year, but it's trading at a very attractive valuation. It's trading at 19 times forward earnings, looking to grow earnings something like 12% for the next 5 years. The market leader up 3.89% this week. And I think we could definitely be bottoming out and forming a consolidation range right here. This stock has both defensive and offensive characteristics. Defense because it's in the healthcare sector, offensive because it is growing. And I think having the best of both worlds in your portfolio, considering all of the volatility that we will get for the rest of the year, that is very, very solid. So to have a company like this would be great, but there definitely is risks with RFK and that type of stuff. But I think this stock offers a great margin of safety and great 5-year forward returns from these valuations right here. And I think we will go ahead and take out all-time highs in the next 12 to 18 months. So those are the individual names I'll be buying. I'm also looking at gold. I'm also looking at Bitcoin, guys. And you know the price targets right now for the S&P 500. Ultimately, our buy zone on this pullback was 54 to 5,500. We didn't quite get there. Like I said, it's not an exact science, but we did sort of get into that range. We just want to wait and see tomorrow and this week to see if we actually get continuation of this move we saw from the bottom, or if this is some form of fake out or bull trap. As the week goes, we will get our answers. But in the year and now, we're aiming for 57.77 per the trade plan, and we want to hold this gamma flip zone. If we can do that, continue to consolidate here, and then make our next move to the upside, that would be positive. Otherwise, we're going to see more downside price action. Either way, political news, trade policy news, and the FOMC is definitely going to continue to move the market as we have very minimal news in the way of data and earnings this week. So guys, continue to add to your positions like here, single stocks as well as indices. This is a good discount. Stuff like mid caps and small caps are even more of a discount. So buy the dip, don't trip. And guys, looking at sentiment, this is Goldman Sachs US Equity Sentiment Indicator, which combines 9 measures of positioning across institutional, retail, and foreign investors, and has historically been a significant signal for near-term S&P 500 returns. Now, we are below the zero line, meaning that positioning coming into this week is less than what it was 12 years ago. In other words, people are holding less equities. Essentially, this is an equity sentiment indicator. And as a result, what this means is that we could see near-term volatility if you look at other periods where we pulled back below the zero line right here. Generally speaking, the markets had a pretty rough go. 2022, 2023, 2018, 2019 right here, 2015, 2016. Markets saw genuine volatility in these periods. And the truth of the matter is the S&P 500 has had a 10% correction. It is one of the fastest on record, having seen a 10% pullback in just 20 days. Now, we've had other corrections that have happened faster, other corrections that happened in a similar time period. And this is obviously caused by a massive shock that happens very, very quickly. In our case, it's the new administration implementing very, very crazy policies, firing 50% of the workforce, a ton of executive orders. And this tends to affect market sentiment. It brings in uncertainty. The market hates uncertainty. However, what we generally see in periods like these, we see a lot of fear. However, that fear is unfounded and we normally resolve higher 3 months, 6 months, and 12 months later. In fact, if you look just 3 months out, we could see returns of about 9.1%. That's median returns, 15% 6 months later, and up to 20% returns 12 months later. So in other words, guys, what this data is telling us is that we should buy the dip, particularly when people get freaked out over uncertainty, when we don't know what the ultimate resolution is going to be. If we also look at everything seasonally, this is the time of year when we normally do bottom. This is the S&P 500 post-election cycle versus 2025. And we've actually followed this cycle very, very closely. We've had a run up here in January into February, a bit of a pullback from February into March. We normally put in a bottom around about this time right here, and then we go ahead, take out the highs, make highs, higher lows into the end of the year with the average return of about 9.7% to end the year. Now, it's going to be a very bumpy road to get there. However, what the stats are telling us is that's what can happen. Now, this can fall apart, don't get me wrong. Seasonality is not a crystal ball. It just allows us to assess probabilities based off the past. Now, history doesn't repeat, it never repeats, but it sure does rhyme. And also supporting a move to the upside from here, at least a tactical bounce, is that we are starting to see buyers buy the dip. Both as private clients saw the largest inflows into equities here, March 2025, eclipsing previous inflows, what we saw, and very similar to what we saw in 2021, 2022. And I think what the market is looking at is stuff like earnings. We're still looking at calendar year 2025 earnings. We're still looking at 11.5% growth. Yes, that is down from the 14%. And that is why we've seen the correction we have. However, we're still looking at double-digit growth for the S&P 500. And then we should see mid-teens growth in 2026. And I think with earnings like these, all dips will be very shallow and will be bought. And something like a correction, even if we do go deeper, you want to buy that dip because higher prices normally resolve. However, everything, guys, will be dependent on the macro. If the economy can hold up, stocks and the financial markets will do very, very well. Now, let's talk about inflation. Now, on Friday, we got the University of Michigan Sentiment Survey, and it not only tells us consumer sentiment, but it also gives us long-run inflation expectations. The University of Michigan survey has the general population expecting 4.9% inflation 1 year from now, and I highly doubt it, guys. We're knocking on the doors of $3 gasoline, with crude oil having halved from early 2022, down significantly from the start of the year. Egg prices are coming down in a very big way. And if you actually look at one of the closest measures to CPI, true-flation is actually on a downward path. Donald Trump was inaugurated right around about here. Inflation has come down in a significant way. True-flation normally leads CPI by about 45 days. And this is actually why I say we're going to have a very cool inflation print in the next one. We're going to print about 2.4% inflation. Then I think we're going to print about 2.1% inflation in the print after that. And then from there, we do see inflation starting to rise. And I think this is in a lot of the tariff news and policies of the Trump administration being reflected in true-flation's gauge. However, I still think we're going to see a couple of inflation prints come in a lot cooler than expected. Something else we are seeing is that the public sector job growth is rolling over. Trump's plans are starting to be seen in the data. This is government plus education and health as a percentage of total payroll growth. This is rolling over. And I think this is what the Trump administration wants. They want the labor market to be less reliant on the public sector and more on the private sector. And this is a very interesting tweet I put out on Twitter. In 2017 to 2020, this is Trump's first term. The public sector had 9% of US job growth. The private sector had 91% of US job growth. In the Biden era, 31% of US job growth was actually in the public sector or just government jobs. That is a huge tick up from what we saw in the prior administration. In the February 2025 report, right, public sector job growth accounted for 7% of US job growth and 93% of it was the private sector. So we're going back to what we previously saw. And essentially what you're seeing is the market rotating from unproductive government jobs right here to the productive private sector. And I think as we see manufacturing onshoring, as we have investment come back into the US, Trump wants to pivot these people right here into the private sector. Can he do it? We'll see. However, that is the plan, and this will be very good for the long-term prospects of the US market. One thing I do want to talk about is the wealth shock we've recently witnessed. Now, the reason why this pullback feels so painful is because with household equity exposure at all-time highs, a 10% S&P 500 correction wipes out a massive amount of wealth equal to 12% of GDP. And that is why people are freaking out right now, because a lot of their wealth, which is in stocks, is being eroded, and they can see that in real time. You don't really see the price fluctuations of real estate or your house because there's no actively traded ticker. However, with stocks, you can get real-time, second-by-second data of what your portfolio is doing. And when you see something like this, you tend to capitulate and you tend to sell. In times like these, you don't want to follow the herd. You want to buy into the fear. You want to buy the dip and just hold, because generally speaking, stocks always resolve higher. Now, looking at earnings for the rest of the week, there's nothing really going on here Monday, Tuesday, or Wednesday. We do have XPeng tomorrow as well as Stoneco after the bell. That's about it. The real big names are reporting here on Thursday with PDD before the open, Accenture as well, and then we get Micron, Nike, and FedEx reporting after close, as well as Lennar. Looking at data tomorrow on Tuesday, we're getting building permits, housing starts, and this is the last data we get before the FOMC economic projections, the rate decision, as well as the Fed press conference. A lot of eyes are going to be on this. Now, the forecast for building permits is 1.4 million, for housing starts 1.34 million. If we beat these numbers, that should bode really well for real estate stocks and rate sensitive stocks, financials too. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.